Hello, traders. It is Tuesday, the 15th of January, 2019. Here in Chicago, it's 8:02 a.m. Thanks for joining me yet again. Day in, day out, day in, day out. We're doing the same thing, hopefully seeing results here and there. One of the things I wanted to talk about today, I'll leave till the end, a little trader wisdom, if you will. But for now, derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, we're seeing we're seeing some mixed markets, slight risk on. It's really a mixed day. Crude is higher, up 1.7% or 86 cents. The Nasdaq's up 30 points. JPM came out this morning with a miss on earnings, causing the S&P to drop about 10 points on the announcement. The DAX is down 12.5 points, just marginally. The Dow is down 7 points. That's just almost unchanged. 7 points is about a rotation, half a rotation. So we have a mixed bag. We have tested down to 2580, but we've also tested to 2600 and a quarter in the overnight session. The market has looked at both sides, and after yesterday being another low volume, relatively low volume day, volumes again was again off about 30%. So that's what we have this morning. Again, the leaders, crude oil in the commodities field, and then in the indices, and the Nasdaq is up 0.44%, and the Russell up 0.22%, and the laggard is the euro, the Japanese yen, the pound. And so we, with a mix in the Treasury complex, the 10 years are up 7 ticks, and so are the bonds. So mixed bag with a slight risk on flavor, so to speak. So that's where we are. The key catalysts this morning, according to my news feeds, really we're paying attention to Brexit. The Brexit vote is today. The margin of a government defeat will determine how both markets and the Prime Minister may respond. German 2018 GDP growth slowed to a 5-year low, 1.5% versus 2.2%. Chinese officials say they will step up efforts to spur economic growth. First phase of RRR cuts take effect. So we're still seeing that. And of course, POTUS, our president here in the U.S., has been just tweeting and tweeting and tweeting everything from sending a letter to North Korea's leader to this wall and this record-setting government shutdown. So it's all in the mix. Of course, news still dominates the day. It's reality TV really in the markets and in real life. So that's where we stand. In terms of what's ahead, we did get core PPI this morning, and Redbook sales. We're looking for the IBD tip economic optimism figure at 10. That's a low tier number, and then we have Fed's Kashkari and Fed's George speaking at 10:30 or 11:30 Eastern and 1 o'clock Eastern. And then after the market closes, we have API crude oil stock change. The consensus is negative 3 million. The prior is negative 6.27 million. And that's what's cooking. So let's take a look at our review segment. Yesterday, the primary expectation, we were opening just outside or below the prior day's range, and I talked about how the market has been opening below in a gap and then pushing higher to close the gap, and the primary expectation was just that. Another chance at buying, responsive buying was expected. back into the prior close and the potentially the point of control. That's scenario one. Scenario two is to push back in to 25.85 and a half or 25.85 resistance, which is the MC point of control. And if sellers are to step in, that's where we would expect them to step in. And then we would expect this to turn around and start heading towards 25.50. That, of course, didn't happen. That's the better trade. But also, scenario one didn't play out as well as we'd like. We did get responsive buying, so there's a check mark for that. We did open just outside, tested down. We did test the key figure to test below is 25.72. 72 was the key area. It went to 70.75 and then became responsive, came back into the range, pushed into this 25.85 area, slowed down a little bit and ended up pushing to 88. Range extension up, multiple tests of the IB yesterday, multiple opportunities, not the IB, the mid, multiple opportunities to mid yesterday back here on the trigger chart as well. And then we ended up pushing into 25.89, and that was the high of day, 25.89.75, and we held steady. Another P-shaped profile. One of the things we want to note is that volume has really dropped and the range has absolutely and completely collapsed. I mean, the entire range yesterday was less than 20 points, but once we pushed in, the range was basically 25.76-ish to 25.89. Really tight versus the prior days. You know, we were having 50-point days quite regularly, and every once in a while, 100, 120-point days to drop to about 13, 14 points yesterday. That's a pretty big pretty big drop. I don't know. I commented this morning in the Convergent chat room that maybe it has something to do with the government shutdown and the government traders being furloughed as well. I don't know. I'm just kidding, but it's just seems like somebody not only hit the brakes, they hit the air brakes, they hit the ground brakes, and they deployed a parachute and they turned on the reverse thrusters on this one. It's like really an incredibly fast slowdown between, say, the 10th and the 11th. The range absolutely collapsed. So be careful. Make sure you adjust accordingly. That your expectations are adjusting accordingly. Currently, rotations have dropped to the point where I can see, an impulse rotation was about 11 points through December and early January. Has dropped to around 6 points. 6 points now for an impulse. 6 points was basically the harmonic rotation for the ES through December and the early part of January. And so all of a sudden, it's just things have changed very quickly. And this sort of change is common. When things become dramatic, they tend to explode. The volatility tends to expand beyond people's expectations, but it also tends to collapse beyond people's expectations. But it also means that there are some tremendous opportunities to lose money. I was reading about someone with a lot of experience who lost a lot of money in trading futures and called it gambling, when really you have to be prepared for this sort of thing. You kind of have to expect that this is in the cards. If you are pulling cards out of a deck of cards and there are cards, there's a suit that you lose points for, you're gonna have to count on the fact that even though you haven't pulled that card yet that causes a loss, that card is in the deck. And this deck that we're playing with here reloads and reshuffles with every pull. So you can't count cards here. Although many people talk about the markets and treat the markets even those who do statistics, they treat the markets as if it's a set deck of cards. It's not a set deck of 52 cards. It is a deck that allows you to pull a card, and then that card is put back in, it's reshuffled, and then you're pulling again. And that's what we're playing here. That's the kind of card game we're playing. But the idea that the market suddenly changes and we lose a lot of money is just there, and that's why risk controls. I know your eyes are going to get red, bloodshot, and glassy, and you're going to go to sleep because I'm talking about risk. But that's why risk control is key, because we are dealing with randomness, and risk control is the only thing that keeps us here and allows us to pull the next card from the deck. Okay, so that's the summary of yesterday. I gave you a summary of yesterday and a whole diatribe here that was probably unwarranted, but I really think it's important to be transparent and share what I truly believe. Yesterday, really interesting in that if you look at how this kind of played out after the close. So if we look at what's happened here, where's my book map? Hello, desktop not available. All right, let me pull this in. We'll make this a part of the review segment. One second. This usually has its own screen. If you look at where we closed yesterday versus where we reopened at 5 o'clock right here, Chicago time. And we could see that the market ran up, flagged, ran up, and has ground its way up all the way to 2600, the century figure, and has since, after poking through the century figure, it has since fallen off. This is JP Morgan right here. JP Morgan, a drop of about 10 points. And then since then, we've been completely sideways with a downward skew. And that brings us to where we are currently. It's a very interesting run up yesterday or last night. We see it here in this chart. And to me, it just looks like the market did a really great job of exploring prices. Look at this profile. We have a triple prong, a trident of a profile, a triple prong profile. The market really actively sought value yesterday and then dropped below the mid, pulled back to VWAP, and then got whacked by the JPM release and has been trading near the low with what looks like now a relatively weak low. It looks like we're likely to continue exploring to the downside because we don't have an excess at the low, and we have not tested down and pushed away from the low. The longer we hang out here, the longer we're likely to do a bear flag that resolves to the downside. That's what it looks like to me. What's interesting is the delta. The delta has been positive the entire session, even after we've pushed back to parity here at the open. The delta is positive, so there was some fairly aggressive buying coming into the open into 2600, and this is normally the muted part of the session, we usually don't see the volume kicking in until about 2 o'clock, which was approximately here when the European markets kick in. But instead, we've been pretty steady on the delta and holding tight. Price, the overnight inventory is mostly long in price and in delta. I'm expecting that to balance out on the open. A big thing I wanted to show, a big thing I wanted to show here is this composite. This is a daily chart of RTH bars. So these are day session only, pit session only. I call this my daily composite chart. And what we have here is the low. I've talked about this before and I've outlined it here. 2607 adjusted for the March contract, 2587 are the two key areas from the micro composite that existed. I talked about it this yesterday actually, the microcomposite that existed from October until it was definitively broken. The middle of December, the 2 months, the two bottoms of 2607 and 2587. And what we did is we pushed right into the center of this band at about 2597 and are falling back off. Yesterday looked like it was starting to one time frame down. Yesterday we had a lower high that followed a lower high from a Friday. So we had a high on Thursday of 99.50. We had a lower high on Friday, and then we had another lower high yesterday. That kicks off the one-time framing down. The market is likely to start rotating lower. Even this is why the run up during the China session or the Asian session was a bit of a surprise there. But there's a lot of resistance in this area right here, and that's where we got tangled here for the last 3-4 days. And balancing out 25.85 being, look at where we're trading, 25.84 and a quarter. 25.85 is the balance zone in this area. Let's move on to what we've got coming for today. What do we have? What are we looking at for today? Shift this over. Again, consider that the ranges have collapsed, and so my expectations have also collapsed in terms of range. And so we're opening right against yesterday's point of control. We're opening right against the MC point of control right here, the MC point of control 25.85. We're opening in a pretty balanced area. So if we take a composite of all these days here, we'll find that the MC is right in this zone, and yesterday's point of control was really in line with the overall balance in this zone. The market balancing over and over and over, day after day after day, means there's more and more trading in the most accepted price area, which also means that it's likely to break away from here. And when it does, it's got so much energy because of a lot of the positions that were taken in that balance area. Balance only exists because a lot of volume traded there. That's how we know balance. And so when it starts to move away, we would expect this to turn into a trend. So what we have here, again, I want to be very, very clear. What we have here is balance, okay? We have balance. Balance leads to imbalance. So when we break away from here, expect trend. Okay, so once we start breaking, don't get caught up in the tick drama. Understand that when we break away from the zone, we're looking for a trend to develop. Again, trend target below 25.50. 25.50 with this stock zone is marked orange right here. I'm working on distinguishing my stock zones. This is a big area, 25.33, 38, and an even bigger area, 25.21. 25.21 will be the ultimate, the extended target to the downside if we break from balance. Okay, so that's quite a ways away, 60 points or so, but we pay attention. If we break away, you don't want to start fading this balance. If we get above 2600, for example, I expect some resistance at 2607. That marks that the upper part of the band I just showed you on the composite. Beyond there, don't try to short it aggressively. It's likely to continue pushing, and in that case, 2614, and then there's some bigger levels extending up. Okay, so this morning the expectation is an open auction in range. Expect balance here to continue. Quiet morning, and then I'm looking for it to test lower, take out the overnight low. Remember, we have a weak low and we have a positive inventory overnight, and then for it to start walking back, I'm looking for an impulse back up, brings us back into range, and then look for this 25.90 to break, and I'm looking for 2600 to get tackled yet again. Yes, that contradicts the fact that I said one-time framing has potentially begun, but again, we are in balance. We are in balance here, and it's had many opportunities to take out the low, and it has not. That's the primary scenario. The secondary scenario is more of the same: push higher, push above 25.89, 25.90, consolidate, and if it falls back in, then I expect that the low is likely to get tackled, and then we're starting to move down the chain here through 25.68 and beyond. So I'm not expecting too much. I'm not expecting that to be a strong probability for today, but I'm prepared for it. I'm looking to see how does it respond in the 25.88, 89 area. If it's not able to push through, then I'm going to look short, and I'm going to be aiming for yesterday's low as a key target. Okay, so that's what we have. You have scenario 3, which is an open test down, drive up. Scenario 4, open test up, drive down, and so on and so forth. The last thing I want to say, having given you that, the last thing I want to say is I want everybody to remember that day trading is not like swing trading. Swing trading is great. You can go and swing trade, the SPY, or, a couple of shares of SPY or whatever if you're underfunded. Futures is very risky because of the leverage. A lot of people trade with $500 margins, and they're trading at a $130,000 notional contract. Per contract, they're holding it for $500. So it doesn't take a big move to wipe $500 per contract on that big of a notional value. And so if you're out there gambling and swinging for the fences and looking for big wins and all that stuff, I'm sorry, but it's not going to work. You're not going to survive. Futures is for professionals. It is really a leveraged product. And so it's meant to be for those that want a broad participation in the market, and want to be able to trade something that is not impacted by one entity or one piece. Be smart. Do not trade for less than 50% of initial margin. Currently, the S&P initial margin is $6,600. You shouldn't be trading more than one contract per 3,300. Better yet, you should be trading one contract for every $6,600 if you can afford it. If you want to swing trade, futures demand a huge account, a big account to swing trade, because the swings can be quite wide. And again, it's a leveraged product. So it's not like day trading is gambling. I refute that. I've been doing this for 19 years as a day trader. I'm not a swing trader. I have no clue how people swing trade. Um, and can sit through 20 points of a drawdown. That would be very difficult for me since I'm a day trader. But this is about some specific things. This is about making a plan that has some sort of an edge. It's easy to vet that out. Um, Respecting your risk, creating and respecting your risk, and then making sure that you're here to trade again. Again, risk control. Make sure you're sizing properly. Make sure you have some sort of accountability to someone, and make sure you have some grit. This takes some grit, as I've always said, and I've said this for since I started prop, probably 15 years. I've always said trading is simple but not easy. Trading is like race car driving or being a fighter pilot or doing anything that requires high performance. It is not for the person who's going to sit back, relax, and just click, 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 click. This is not what this is for. Is Futures trading is for those who seek to be professional and who want to take advantage of what futures have to offer. And what futures have to offer is a market that's open a lot, most of the time, is an efficient use of your capital. You don't need that much capital. You can get long and short, whatever. There's no day trader pattern rule. It has a 60-40 tax advantage here in the US, and various other features. Also, it doesn't get impacted because some person doctored up some books or doctored up the accounting for a company. It's a wide swath that we're trading, but it is a leveraged product. So it is not suitable for all investors. This is just word to the wise. Good luck today, and I'll catch you tomorrow. Take care.